Hi everyone, I wanted to provide a quick intro overview to Chapter 5. So a little bit of a recap of what we discussed today and looking ahead into Wednesday's lecture and, or I should say accounting lab. So we have three main concepts with Chapter 5 related to gross income that we're going to be looking at. The first one is this idea of economic versus taxable income. Okay, so imagine you have a stock that has increased in value by $1,000. Okay, you own the stock at the beginning of the year, you own the stock at the end of the year, but over the course of that year, the value of the stock has gone up. Okay, that is economic income. That's basically an asset that you own that has appreciated in value. Contrast that with selling the stock at the end of the year for a $1,000 gain. Okay, so at the end of the year, you actually sell the stock, someone's willing to pay you money for it, and you make a $1,000 gain. This is taxable income. It's also economic income, but it's taxable income as well. We need a transaction for any taxable income to be recognized, okay? In this example, the increase of our own wealth of an asset that we still own, there's no transaction there. We're not selling it to a third party, to another party. So accounting income, economic income. That's theme number 1 of Chapter 5. Okay, major theme number 2 is that we're going to be looking at different types of income and also different types of exclusions. And this is going to be an area where we're going to learn with practice and with just getting more familiar with the Form 1040 and with just different types of facts that can arise, okay, when we look at different examples. So I want you to take your time with this, okay? This is not something that, that comes overnight. It just takes with practice. So we're going to see like rental income, fairly intuitive, right? You can own a property and rent it out and earn rental income. Well, that income is kind of like, it's just like salary income. It just comes from a different source. Instead of your employer paying you, you have renters who are paying you. But we're also going to see, in addition to different types of income, we have different specific exclusions, like municipal interest. The IRS has made a rule that says, or I should say Congress has made a law that says that municipal interest is excluded from taxable income. So that's why, we're going to see, and we've seen in Chapter 1, we saw it again in Chapter 3, and now we're seeing Chapter 5, these different types of exclusions. And it's really just to help us understand that not all income is taxable income. This is an example of earned income. There is a transaction here where you did get a check from the local municipality for which you own a bond, and you received some interest related to that bond. That's the $750 there. But the IRS is not going to tax you on it, okay? So in this example, we have earned income or economic income of $3,450, but only taxable income of only $2,700. The $750 is ignored for taxable purposes. Okay, third major theme is this idea of constructive receipt. Now, the idea here is that we have to have access to the funds in order for it to be considered taxable for us as a taxpayer, okay? And this kind of gets at the idea, it's similar to kind of like a cash basis idea where, you're taxed on the cash that you have access to, throughout the year. And the idea here, let's look at this example. December 23rd, at the end of the year, you receive a paycheck from your employer. As your employer is handing you the paycheck, she says to you, listen, don't go to cash this check until January 10th because business has been tight and it will bounce if you try and cash it before January 10th. So do me a favor, wait until January 10th. Wait about 2 weeks and then go to cash your check. You do not have constructive receipt to your paycheck. Your paycheck is basically meaningless on December 23rd, and your employer has told you that. If you go to cash it, it's going to bounce. You won't actually get the funds that you deserve to get. So the idea here is that constructive receipt happens on January 10th, and that's when the taxable income comes into your hands. So this paycheck will be included in the January 10th tax year, not the December 23rd tax year. So we're going to see examples of this in the homework. Constructive receipt, recognizing different types of income and different types of exclusions, and also economic versus taxable income. There's a lot going on. Take your time with it and keep in touch with questions. And these chapters will kind of speak back to previous chapters. So as we do Chapter 5 and we focus in on gross income, we're going to be looking again at the tax computation, which is Chapter 4. So keep doing the work, do your best to keep up, and keep in touch with questions, and we'll keep moving ahead in the course. Thank you so much.